And thank you for joining us. On today's show, we want to talk about bonds and interest rates. And how are bonds affected by interest rates, Matt?
Well, bonds are very interest rate sensitive. So what's happening with interest rates can either be positive or negative for bonds. So basically the way that it works, as interest rates rise, bond yields will fall, and it will drive the value of a bond, or in particular a bond mutual fund or bond fund, down in value. And this is why I'm glad we're talking about this today, Melissa, because interest rates have gone up a little bit here recently, but they're still really near historical lows, very lows, nowhere near the averages. So as interest rates, I think, will continue to rise at a slow pace, but as that's happening, what will happen to bonds is their yields are going to fall, and that's going to drive the value of bonds and bond funds down. And it's an important topic because a lot of our viewers are going to have bonds or bond funds in their portfolio, and they think that that's maybe their safer portion of their portfolio, and they don't have to worry about it. And although we at Strategic Wealth Designers will agree that bonds and bond funds are safer than stocks, they certainly aren't safe. They can have a time and a place, and right now is just not the time. And if you're within maybe 5 to 10 years of retirement or already retired, I don't really think they have any place in your portfolio, because we know interest rates are going to go higher, and we know when that happens, bond yields go down, and we know when that happens, the value of the bonds fall.
So are we talking about different kinds of bonds? Are there different kinds of bonds?
Well, yeah, and a lot of people use bond funds as a safety net, and like Matt was saying, they're very interest rate sensitive. You can think of them kind of like they're on a teeter-totter or a seesaw, and when interest rates go down, bonds go up. So where are interest rates right now? I know that they're creeping up, but we're still right around all-time lows, which that puts the bond funds around all-time highs. And when you talk about different types of bonds, the reason that people use bond funds as their safety net is that first word, bond. Now, with a bond, if you hold it until its maturity date, you can get your money back. So the value of it going up and down, you don't really like it, but at least you're going to get your money back. As long as that company's still there, or government entity. But with a fund, a bond fund, there's a manager that's buying and selling bonds, hoping to make their fund profitable. So what that means...
So when I'm buying a bond, I'm not necessarily buying a municipal bond. I'm not buying to build a bridge or something for the city. Or that's not always that kind of bond.
No, that wouldn't always be the case. There are municipal bonds that you can go after to do that. But with a bond fund, there is no maturity date. So if it loses value, then you just have to sit and wait.
Yeah, and there's more money in bond funds really right now than individual bonds. And most bond funds, Melissa, to your question, they don't really use municipals very much. I mean, there's some that do. But most of the time when you own a bond fund, it's going to be corporate bonds for the most part. They might have a little bit in municipals, but the majority of it's not going to be there. So it's a situation where when interest rates go higher, like we mentioned, bond funds in particular lose value. That's what most of our viewers probably will have some money in. And I want everybody, if you're at home, to maybe take a note on this or write it down or listen closely. But for every 1% increase in interest rates, a bond fund is going to lose on average about 8% in value. So interest rates right now are 2 to 3%. Historically they're somewhere between 5 and 6%. So we could easily see a 2 to 3% increase in interest rates, not overnight, but over time. And if you use this ratio I just gave you, if interest rates rise 2 to 3%, that means that bond funds stand to lose on average, 15, 20, maybe as much as 25% in value. And it's an asset category that a lot of people mistakenly believe is safe. And quite frankly, a lot of financial advisors mistakenly believe is safe, because a lot of people lost money in 2008 through the financial crisis. And so what their advisors did is they said, okay, we're going to shift money. We're not going to have 80% in stocks and 20% in bonds. We're going to shift it so now you have maybe 50% in stocks and 50% in bonds. And so there's a lot of people that mistakenly believe, well, half of my portfolio is protected, when in this environment that we're in right now with rising interest rates, really none of it is protected. 100% of the portfolio is exposed to significant risk, and there's basically nowhere to hide the money when we're in one of these environments.
What if you have someone that's 60 years old? What would you do in this case? They're 60 years old, they have a 401k, they're still working, maybe 2 or 3 more years, but they're using bond funds as their safety net. I mean, would you recommend anything different there?
Well, if they're still working, obviously we talk here on the show about possibly doing an in-service distribution or an in-service rollover to see if maybe they can roll the money out of that 401k and into something where we can maybe use some things that would be truly diversified and a little safer than bonds.
Yeah.
And we're talking about what's going on in the market right now. Say you do have quite a bit in bonds or you have very little in bonds. Well, what should you be doing? What getting advice, I know, but moving what around? What would you advise?
Well, I for one don't think anybody should have any money invested in bond funds at all right now. We know interest rates are going to go higher. The bond markets are very volatile right now. There's a lot of what's called turnover within the bond funds. I don't want to get too technical here today, but the higher the turnover on your mutual fund, the higher the expenses are on that fund. Because as that fund manager, like Dustin mentioned earlier, is buying and selling different bonds, trying to turn a profit, you're paying a fee every time that they buy and sell. And sometimes they're buying and selling and you're losing money. So what we're seeing right now is bond funds are extremely expensive and the writing is on the wall. Nobody can predict the future, but sometimes it's obvious what direction things are going. Interest rates are going to continue to go higher. The government has told us they're going to continue to raise interest rates. So therefore, nobody should have any money invested in bond funds in their portfolio. If they have that, that's a clear indication to advisors like Dustin and myself and everybody else at our firm that whoever the individual is working with currently, they're kind of asleep at the wheel or nobody's minding the store because it's obvious what direction things are going in, therefore nobody should have bond funds in their portfolio.
And can you just switch? Can I come in someday and say, okay, I want to get out of this, or is there a time period?
Yeah, you certainly should be able to switch investment options that you're in, no matter what you're using, whether it's a 401k or an IRA or whatever the investment is, you're certainly not tied to a bond fund. There should be options that are out there. But it's important to be speaking with an advisor to help get the guidance to use the right tools.
All right. Thank you both very much. And if you're concerned about bonds in your portfolio, you can visit swdgroup.com. Stay tuned for more Strategic Wealth with Matt Dicken right after the break.
You can kind of think of it as if they're sitting on your side of the table, negotiating on your behalf. So what that means is they have to recommend things that are going to be in your best interest.
Look, nobody's born knowing how to plan for retirement. So why not start your retirement education the same way thousands of Kentuckiana couples have by attending one of our educational seminars created and hosted by the financial professionals at Strategic Wealth Designers. The retirement professionals at Strategic Wealth Designers will show you ways to make informed decisions. For many, this workshop was the first stop on the road to their successful retirement. Register for an event that works best for you at swdgroup.com/events.
So we've been hearing a buzzword on the news a lot over the past year, and what it is it's fiduciary. But how many people actually know what that word means? Now, anytime that you go get financial advice, the advisor or the broker that you're going to work with is going to be following one of two standards. Number one is what's called suitability, and that's probably the most popular standard that's out there when it comes to financial advice. The other is the new buzzword is fiduciary. And all that means is if you go see someone that's following the fiduciary standard, you can kind of think of it as if they're sitting on your side of the table, negotiating on your behalf. So what that means is they have to recommend things that are going to be in your best interest, that are going to help you accomplish the goals, the objectives that you have throughout your investments or throughout your retirement. Where when it comes to the suitability standard, this is where they're actually representing their companies. Well, what I mean by that is their boss probably had a goal or they had a quota that they needed to make, and they have team meetings and they tell their advisors, okay guys, here's the tools that we need to recommend this week. So what that suitability standard advisor will do is he's going to sit down and talk to the client about what are you trying to accomplish through your retirement. And then they're going to somehow make these tools that their boss told them to sell fit your scenario. So that's not necessarily going to be in your best interest. Now, they do have to recommend things that are suitable, but again, that doesn't necessarily mean that it's in your best interest. Where with a fiduciary advisor, what they're going to do is they're going to sit down and talk about what are your goals, what are your objectives, how much risk are you comfortable with, what types of investments are you used to, what do you want to stay away from. And then based on those goals and based on your comfort level, then they're going to recommend investments or strategies that with those goals in mind. They're going to be in your best interest in order to help you accomplish the goals and the objectives that you have. Now, I know a lot of people think that the fiduciary standard is what every advisor is going to follow now because it's the buzzword that we hear on the news. But that's just not the case. There's two different types of investments, or two different types of money, non-qualified and qualified. And what this means is non-qualified assets mean that it's after-tax money. So you've already paid the taxes on that investment. Where with qualified dollars, or IRAs, 401ks, 403bs, what you've done is you've taken the deduction and you haven't paid the taxes on that investment yet. The new fiduciary standard that we've heard about in the media is only protecting qualified dollars or IRA dollars. Where with the after-tax dollars, it's still suitability standard or whatever standard that your advisor is currently using. So they're not necessarily protecting all of the assets. Where with a true fiduciary like Strategic Wealth Designers, it's a full comprehensive plan where we are fiduciary on all assets, not just qualified or non-qualified, but everything. So it's always important to make sure that if you're going to work with an advisor, that they're going to have your best interests in mind. So what I mean by that is that let's say that someone comes into our office, and what we're going to do is we're going to talk about, okay, you want to retire in January 1st of 2019. Okay, how comfortable are you with risk? What are you used to as far as investments go? Do you like bonds? Do you not like bonds? Do you like annuities, or have you used annuities? And based on your answers and your comfort level with certain investments, we're going to design a portfolio based around those goals. Now, if you've got 20 years left or maybe 25 years until you're going to reach retirement, you're building your 401k, well, you're probably going to take quite a bit of risk at that point. So you're okay with the market volatility or the fluctuations in the value of the stock market. But once you get closer or into retirement, now your objectives really need to change. You really need to have kind of a paradigm shift in your whole mode of thinking. You were used to taking that risk when you were building your 401k, but now you really need to scale back on the level of risk that's going on. You no longer have time on your side if you're retired or maybe within about 5 years of retirement. Now, what I mean by that is we follow a rule at our firm called the Rule of 100. And basically all it is a very simple rule. You take your age from the number 100. That's the percentage of assets that you want completely safe from market risk. Then with the balance of the portfolio, that's where you can go out and take a little bit of risk with it if you're comfortable with that. Now, we've got some clients that they don't want any risk, and that's fine. You can build a portfolio that can work that way. I've got other clients that they wouldn't know what to do if they weren't watching it every day. There is no cookie cutter approach to financial advice, and that's why I think it's so important to make sure that you're working with a fiduciary. Things that used to work in the past, like the 70-30 split with bonds or stocks, or 60% bonds, 40% stocks, those things are kind of a thing of the past. You can still use bonds in your portfolio, that's okay. You can still use stocks, and that can be okay. But now you want to mix things like exchange-traded funds or ETFs, or maybe treasuries when interest rates look appropriate or look enticing. Maybe you want some fixed annuities or indexed annuities. So what you want to do is you want to work with someone that has all of these assets and tools at their disposal so that they can build a portfolio that's really around your needs and around your goals. So if you have any questions about your portfolio or whether or not you're currently working with a fiduciary, feel free to give us a call at our office.
Whatever your age is currently, that's the percentage of your retirement assets that should be safe and protected from risk, meaning you can't lose any money on it. And then the difference between your age and the number 100 is the appropriate amount of money that you could have at risk in the stock market, only if you're comfortable with that risk.
WHAS 11 salutes Strategic Wealth Designers as a leading retirement and wealth management firm in Kentuckiana. The advisors at Strategic Wealth Designers have been helping retirees and pre-retirees live a safe and stress-free retirement since 2002.
Let's discuss a rule that we follow very, very closely at our firm, and that's something that's called the Rule of 100. I really kind of think this is kind of a foundational belief that we have within our firm, that individuals as they get closer and into retirement really need to start following this rule. Now, some of you are already very familiar with this rule, but for those that aren't, let's spend a few moments discussing it. Basically what the Rule of 100 says, or what it means is this: whatever your age is currently, that's the percentage of your retirement assets that should be safe and protected from risk, meaning you can't lose any money on it. And then the difference between your age and the number 100 is the appropriate amount of money that you could have at risk in the stock market, only if you're comfortable with that risk. Doesn't mean that you have to have that amount of risk, but if you consider yourself to be maybe a moderate investor or conservative to moderate investor, we really recommend that you follow the rule of 100. Now, a word of caution. Sometimes individuals think, well, I've got a really diversified portfolio, so something like the rule of 100 doesn't really apply to me, or sometimes they'll feel like, well, I've already got a diversified plan of stocks and bonds, so I'm already following this rule, or I'm good. And that can be fairly risky. We've seen times in the past where when all of our assets are correlated, even if you have it in a lot of different stocks or a lot of different bonds, different mutual funds, when we go through time periods like 2008, or obviously the year 2000, September 11, things like that, sometimes all of those assets fall. So again, the real crucial point to remember here is that percentage of your portfolio that should be safe means that you can't lose any of the money that you have invested in it or any of the growth, because you don't want to have to make up for lost time. So as an example, let's talk about this. Somebody that is 65 years old should have 65% of their assets in things that are safe, meaning they can't lose any money on it. That would obviously mean that no more than 35% could be at risk in things like stocks, bonds, mutual funds, some sort of a diversified portfolio. Now, whenever we talk about this rule, we always have to point out, don't get too stressed out on hitting the percentages exactly. You know, if you're 68 years old, it doesn't have to be exactly, 68, 32. Just be close. Within 5 or 10 percentage points, one way or the other, is really fine. Now, as you get closer into retirement, meaning maybe about 10 years out from possibly retiring and needing to take some money out of your accounts, we really highly recommend at that point that you do not deviate from this particular rule. At that point, it's just too close. You're getting too soon to the date where you might actually need the money. Because a lot of people don't realize this. When you lose money in the stock market, the average amount of time it's going to take you to recover from that is going to be 7 years. That's the average. Obviously, sometimes you recover faster than that. Other times it takes a lot longer than that, though. The longest it's really ever taken the stock market to fully recover is 18 years. So could you imagine going 18 years with absolutely no growth whatsoever in your portfolio? Now, we can never predict when we're going to see that again. So that's why it's important to try and follow things like the rule of 100. Now, another thing that we will sometimes hear from individuals is they'll say, well, if the stock market loses a lot one year, as long as you don't sell, it's just a paper loss. If the market rises nicely the following year or the year after, you're going to be able to break even, pretty quickly. And that's not always the case. If we take a look at a year like 2008, we know some individuals lost a pretty significant percentage of their portfolios. It wasn't uncommon for us to hear individuals losing 30, 40, sometimes 50, 60, 70% or more of their retirement assets. But let's say if it was a 50% drop in the market during 2008, sometimes people think, well, if the market lost 50% and then the following year went up 50%, well, I'm back to even. And obviously those that have gone through experiences like that know that that's not really the case. If the stock market were to lose 50% one year, then the next year it would need about 100% return just to break even. That usually doesn't happen one year after the next. So that's why on average it takes about 7 years to fully recover. So let's talk about some examples of things that could be safe. If you're going to try and follow this rule of 100, whatever your age is, again, is the percentage that should be protected from market losses. So what we're talking about there are going to be things like possibly savings accounts. Obviously, CDs are going to be safe. Unfortunately, right now, neither of those are paying much interest. So sometimes individuals are using certain types of bonds. Now, not all bonds are safe. Some are, but not all. There are certain types of annuities. Again, not all would be considered safe. The ones that you would want to use would be maybe a fixed annuity or an indexed annuity. Both of those are going to have some sort of guarantee on them. And whatever your age is, that's the percentage of your retirement portfolio that you want invested in those types of assets. Now, again, for the rest of your portfolio, that's where you could use things like stocks, bonds, diversified mutual fund portfolio, maybe exchange-traded funds, or sometimes referred to as ETFs. That's where your real estate investment trust would fit, as well as certain types of bonds, higher risk bonds, and then maybe things like variable annuities. So it's really important that you follow this rule of 100. I can't stress it enough. As you get closer and into retirement, we really define that anybody that might need or want to use the money within the next 5 to 10 years. And a lot of times individuals are really uncertain. They're not really sure how much of their portfolio is safe now. And if they're not following this rule, they're not really sure how they get there. It's probably best not to try and panic and try and do it all overnight. So if you're not really sure how much risk you have in your portfolio currently, or how to get yourself in alignment with the Rule of 100, then by all means, you could visit our website for more information or give us a call at the office and you could sit down and talk with one of our advisors and educate you a little further on the Rule of 100 and why we consider it so incredibly important.
It got worse, and here he thought that he was in a conservative portfolio, but what he told me is he said, I still see the value each month fluctuating. I don't feel like it's as conservative as his advisor told him, and he was right.
Look, nobody's born knowing how to plan for retirement. So why not start your retirement education the same way thousands of Kentuckiana couples have, by attending one of our educational seminars created and hosted by financial professionals at Strategic Wealth Designers. The retirement professionals at SWD will show you ways to make informed decisions. For many, this workshop was the first stop on the road to their successful retirement. Register for an event that works best for you at swdgroup.com/events.
So all of our viewers really want to have a secure, successful retirement, but we know that studies say that 60, maybe 70% of the time, individuals are going to struggle at some point in the future during their retirement. Yeah. So, you know, it doesn't seem like it should be that difficult, Dustin. So what are some of the most common mistakes that we see in the office? I know we have thousands of people coming through the office every year. So what are some of the more common mistakes individuals are making that cause them to struggle at some point in the future?
Yeah, that's a great question, Matt. And one of them I see almost daily. And what it is it's carrying far too much risk going into retirement. I think about, every time I say this, I think about a gentleman that I met about a year and a half ago. And he came into the office and he had just retired. And he said, Dustin, I lost 40% of his portfolio.
Wow.
In 2008, he lost 40%. So he went to his advisor, you know, once he was getting ready to retire, and he told him, listen, I don't have time for this anymore. I need you to scale back on how much risk that I have. Well, his advisor says, no problem. I'll make the adjustments for you. So he did. He changed him and moved him into a quote unquote more conservative portfolio. Now, the reason that I say quote unquote is when he came in to see me, we actually ran a stress test on his portfolio. And we plugged it in against 2008 just to see, okay, you know, he lost 40% back in 08. Well, if it had happened again that day, he would have lost nearly 48%.
So it actually got worse.
It got worse. And here he thought that he was in a conservative portfolio, but what he told me is he said, I still see the value each month fluctuating. I don't feel like it's as conservative as his advisor told him, and he was right. So
and do you think some of that is individuals kind of listening too much to what other people out in the marketplace are saying? I mean, I know the last several years, the stock market has done fairly good.
Yeah.
And so it's kind of like you have people that maybe go to the racetrack and bet on the horses. They want to tell you all the times that they won,
right,
but they probably don't ever mention the times that they lost.
Yeah, and that's a great point. That's one of the biggest things that we hear is envy. You know, it's thinking about like the Bitcoins or the Snapchats, or it's the hot stock tip of the week. That stuff's okay when you're accumulating your wealth, when you're building and you have time on your side. Once you get to retirement, though, if one of those takes a turn, it's likely it's going to take quite some time before you get back to where you were.
Now let's talk a little bit about the difference, I think, from individuals that are closer into retirement, really not necessarily having the right investments for that particular stage or that particular point in their lives.
Yeah, because there's a certain set of tools you're going to use, and we relate it to the climbing Mount Everest. And when you're climbing the hill, you can take a bunch of risk because you got plenty of time. If it drops, you're not excited, but that's okay. You have time. Once you get to the top of that peak, and now you're starting to turn the corner, well, now if you start to roll, there's no stopping it. So what you want to do is you're going to start to scale back quite a bit on the level of risk because you just don't have time to make up for a loss anymore.
Yeah, and I think probably one of the most important reasons why you don't want to incur a loss is because when you do lose money in the stock market, on average, we know that it's going to take about 7 years for you to recover from that. I mean, it's been as long as 18 years, but the average is just 7 years. Now, talking about long periods of time, I know individuals are living longer and longer. So does that cause us to have to kind of view retirement a little bit different and maybe add some things that maybe our parents or grandparents didn't have?
That's another great question. Long-term care, I mean, sometimes people don't have a plan in place. And if one or both spouses need to go into a long-term care facility, it can drain the entire portfolio if there isn't things set up prior to one of them needing it.
Now, I think one of the exciting things around this particular topic, though, is that the different financial institutions that are out there, some of which we work with, have gotten a lot more creative. You know, long-term care insurance is Unfortunately, it's expensive.
Yeah, it is.
And then also, unfortunately, not everybody qualifies for it. But the companies have gotten a little more creative over the years, and they have some hybrid plans.
Yeah.
Which can provide some money if you need to go into a facility, or what's more likely to have someone come into your house to help take care of you in your own home. But then if you don't need it for that, it doesn't necessarily cost you as much as a standalone insurance policy does.
That's right. And there's sometimes where someone gets denied. They want long-term care. They go try to apply for it, and then they get denied. There's still ways, like you were saying, they make hybrid plans where they don't necessarily have to go through an underwriting process.
So some of the cost of providing a plan for long-term care has come down over the years.
Yeah.
But what about some other fees in someone's portfolio that they need to be worried about?
Well, that's another good point. We see all the time where double dip accounts, for example. Variable annuities would be another example. And when we test these reports using our strategic wealth report, we'll see fees anywhere from 2 to, I've seen them as high as 8% on a variable annuity. So it's so important to get your arms around how much are you really paying each year. Because if you think about it, let's just say 3%. If it's a $500,000 portfolio, $15,000 a year. I mean, that starts to really add up.
And it's every single year.
Yeah.
So kind of going back to what we were just talking about, as individuals are living longer and longer,
Yeah.
you know, some people watching the show today, they're going to be in retirement for certainly 10 years, you know, some 20 years.
Yeah, some 30,
some
40.
30, 40 years. And so if you're paying excessive fees, let's say it is costing you, you know, $15,000 a year. Well, I mean, that's $150,000 over 10 years. That's $300,000 over 20 years,
Yeah.
you know, assuming no growth on it.
I can think of a lot more things to do with $300,000 than paying fees. I can tell you that.
Absolutely. Well, what about just having an overall income plan? Do you find that most people that are out there today getting close and into retirement know exactly where that income's going to come from? You know, retirement's exciting, but it can also be a little bit scary.
Yeah.
You go from getting paid twice a month or every 2 weeks or
Yeah.
whatever your employer's paying you to really not having, you know, some sort of guaranteed income source in a lot of cases. So what is it that you recommend in those scenarios?
Well, we always run what's called a retirement income analysis for our clients. And I think that if someone is retired or they're soon to be retired, if they're working with someone that actually helps with retirement planning, they should already have one. But what it is it's a document where we go through and we look at what is their Social Security. Is there any way we can maximize it between the spouses? Or is there a pension? Is there something we can do to help maximize that and make sure it's going to last as long as we need it to? We can look at assets, and then how do we leverage those to give guaranteed income that's going to last the rest of their life? And then we can look at their expenses with inflation 20, 30, 40 years from now, and make sure that their money's going to last as long as they need it to.
And that's really what it comes down to, right?
Yeah.
So if any of these mistakes sound familiar, or you're concerned that you might make some of these mistakes in the future, it really makes sense to sit down and talk with a professional, try and have a game plan to kind of address each of these issues that Dustin and myself have brought up here today.